Welcome to our first video from Chapter 3 on the corporate income tax. I've split the chapter into two videos. There really wasn't a natural breakpoint, so we just have Part 1 and Part 2. So here we go. The corporate income tax rate, very simple. It's a flat 21%. So there's no complicated tax rate schedule, just 21% of your taxable income. That's your tax. The formula to compute corporate taxable income is also simpler than what we're used to from individual taxable income. Taxable income is simply gross income minus deductions. So there's no split between adjusted gross income and deductions for and from. Definition of gross income is the same as for individuals, but the deductions are simply going to be expenses related to the production of income. Anything else is not going to be deductible. So no medical expenses or personal interest expense or any of those other things that we had for individuals. To understand the computation of corporate taxable income, start with the rules for individual taxable income and then focus on the differences. Most of what we're going to be doing in Chapter 3 is just talking about what is different between individual taxable income, where we already know how to do that, and corporate taxable income, which we are now learning. So, first, capital gains and losses are treated differently for corporations than they are for individuals. There is no special tax rate for capital gains. Everything's 21%. There's also no deduction for capital losses in excess of capital gains. So the $3,000 capital loss deduction that an individual would have, that's gone. If you have a capital loss in excess of capital gains, you cannot deduct it. You can carry it back 3 years and forward 5 years, but only for deduction against capital gains. Otherwise, you can't use it. And if the 5 years runs and you never had any capital gains, the loss expires without you being able to deduct it. Let's take a look very quickly at problem number 31. In the current year, Riflebird Company had operating income of $220,000, operating expenses of $175,000, and a long-term capital loss of $10,000. How do Riflebird Company and Roger, the sole owner of Riflebird, report this information on their respective federal tax returns for the current year under the following assumptions? Letter A, Riflebird Company is a proprietorship. Roger did not make any withdrawals from the business. All right, well, the proprietorship, operating income, $220,000, operating expenses, $175,000, subtract, and you get net income from the proprietorship of $45,000. That's going to be included in the individual's gross income. On a Schedule C, we all remember the Schedule C from Tax 1. Probably, they didn't say much about what this proprietorship does, but there's probably a QBI deduction. That's 20% of the $45,000, which would be $9,000. And so the net that is going to increase Roger's taxable income is $36,000. Roger will also get a capital loss deduction of $3,000, and the other $7,000 will be carried forward. That's for a proprietorship, where it's going to show up on your individual tax return, the business income on Schedule C, the capital loss on Schedule D, but you will be able to deduct $3,000. Now, letter B says Riflebird Company is a C corporation and no dividends were paid. Okay, so now we have a corporation. Operating income still $220, operating expenses still $175, so net income at the corporate level, $45,000. Capital loss deduction is 0. We had no capital gains. We had a capital loss. We can't use it unless we have capital gains. We will carry over or back the $10,000 loss, depending on whether we had any capital gains in the previous 3 years. We can carry that back or wait and see if we get any capital gains in the next 5 years. The tax on that corporate net income then will be 21% of 45,000, which is $9,450. Let's do problem 39 next. In the current year, Tanager Corporation, a calendar year C corporation, had operating income of $480,000, operating expenses of $390,000, and in addition, Tanager had a long-term capital gain of $55,000 and a short-term capital loss of $40,000. Compute Tanager's taxable income and tax for the year. So operating income in this case was, for letter A, $48,000. Operating expenses, $390,000. Net operating income, therefore, is $90,000. Now that's before the capital gains and losses. We had a net long-term capital gain, $55,000 gain minus the $40,000 short-term loss, $15,000. So total corporate taxable income, $105,000. The tax at 21% is $22,050. Letter B, assume instead that Tanager's long-term capital gain was $15,000 rather than $55,000. Everything else is the same. So now compute Tanager's taxable income and tax for the year. So operating income, no change. Operating expenses, no change. So we still have net operating income of $90,000. But now instead of a $15,000 net long-term capital gain, we have a net short-term capital loss of $25,000, but we can't deduct any of it. No deduction for capital losses in excess of capital gains. So taxable income is $90,000, and that is $18,400 at 21%. We will have a carryover of the $25,000 capital loss. Again, that's forward or back. I call it a carry over, so we're carrying it over to the future or perhaps to the past. We don't know what Tanager had in the past, whether there are any capital gains. If so, we can take the loss back. If not, we have to wait and see if we get any capital gains in the future. Our second difference between individual and corporate taxable income has to do with depreciation recapture. Now, this is something we cover very late in Tax 1. So let's just review. For all taxpayers, here are the rules. Depreciable assets in business land held more than 1 year are not capital gains and losses. They are Section 1231 gains and losses. If it's a net loss, it's ordinary. If it's a net gain, it is capital, but you have to do the 5-year look back. So it's only net gains in excess of 1231 losses from the prior 5 years. You clear that, anything left is a long-term capital gain. Depreciation recapture, which is what we're talking about here, says, well, wait a minute, we're not going to call these 1231 gains and losses if it's depreciable property. Gains are ordinary, not Section 1231 gains and losses, up to, well, if it's personalty, machinery and equipment and other non-real property, all prior depreciation. So gains up to any prior depreciation is ordinary, not capital. As a practical matter, that means that you're not going to get a Section 1231 gain on the sale of personalty. You might sell it at a gain, but you're not going to sell it for more than you originally paid for it. Usually. It's theoretically possible, but it just doesn't happen very often. And so personalty, all of your gain, if you have a gain, is going to be ordinary, not Section 1231, as a practical matter. Although it's theoretically possible you could have a 1231 gain on personalty. Rule for realty, prior depreciation in excess of straight line is ordinary. So gains up to prior depreciation in excess of straight line will be treated as ordinary. Practical matter there, well, we have used straight line depreciation for realty for a very long time. And most of the property that was placed in service back when you could use excess depreciation, some sort of declining balance depreciation, that realty is fully depreciated. And so there is no depreciation in excess of straight line at this point, because once it's fully depreciated no matter what method you used. As a practical matter, for realty, depreciation recapture will not change your Section 1231 gain into an ordinary gain, because you just simply won't have any depreciation recapture. So for personalty, no 1231 gains generally, and for realty, all 1231 gains, no recapture at all, as a practical matter. But anyway, those are the rules. We learned about them at the very end of Tax 1 for individuals. Now, what's the big news with corporations? Special rule for corporations that sold depreciable realty, where it's very unlikely there's going to be any depreciation recapture at all. For corporations, 20% of the difference between the depreciation recapture for realty, probably zero, and what it would have been for personalty, probably 100% of the prior depreciation, 20% of that difference will be reclassified as ordinary. So it's not a capital gain anymore, it's ordinary. Then the next question is, well, why do I care? Well, you 21% tax rate for capital gains and ordinary gains. The only thing it's going to help you with is if you have capital losses. Then anything that's treated as a capital gain, including a Section 1231 gain, can be used to offset your capital loss. Other than that, capital gains don't do you any good at all at the corporate level. Interest expense deduction. Now, we know that individuals can deduct interest expense. Most common is home mortgage interest. Corporations don't have that. You might also have business interest expense on your Schedule C if you have business interest for your sole proprietorship. Corporation might also have business expense, interest expense. And so the question is, can we deduct it? Well, generally, yes. For small size corporations, yes. But there may be a limit. Now, the limit is not going to apply to little corporations, but there may be a limit that will apply if the corporation is big enough. The limit only applies to corporations with annual gross receipts of 25 million or more. So that's not Fortune 500 huge. It's big, but it's probably a large client for a regional Syracuse accounting firm. That would be about the size we're talking about. So you could easily find yourself working for a regional Syracuse accounting firm or for the client of a regional Syracuse accounting firm where annual gross receipts are 25 million or more. In that case, these limits would apply. If the limit applies, the deduction is going to be limited to, well, 100% of business interest income. So first of all, if you had business interest income and business interest expense, anything up to your business interest income, say, yeah, you can deduct that. We're making you include the interest income. Seems only fair we should give you the interest deduction. Plus 30% of other taxable income before any deductions. So you've got your business interest income. You can offset that with interest expense up to 100%. And then any other taxable income, only 30% of that other taxable income. And that is taxable income. Now, this is good news because we're not going to count deductions for depreciation, including Section 179 deductions, as well as depletion and amortization. So that means that you can take that 30% limit before you subtract that stuff out. So it gives you a higher limit for your interest deduction. So that's, as I say, good news that it's going to be before these particular deductions. Floor plan interest. That's a special type of interest. Generally, it's auto dealers. I guess there could be others, maybe furniture dealers or something, where they finance their inventory. And so furniture dealers could also wind up financing inventory through debt. And they call it floor plan interest specifically if you're an auto dealer and you have cars sitting in the showroom floor. The interest that they pay on that is not going to be subject to this limit. So you can ignore floor plan interest if you happen to be working for an auto dealer. And their gross receipts of 25 million, you don't have to be that big of an auto dealer, I wouldn't think, to hit that level. Although if you're a drugstore, $25 million in gross receipts is, you'd have to have several different outlets before you got to that point. One auto dealer could probably hit 25 million a lot quicker than one drugstore. Okay. Anyway, floor plan interest will not be counted as subject to this limit. Fourth, charitable contributions. We know that charitable contributions are deductible by individuals as itemized deductions. There are some limits, 60% of AGI for cash, 50% of AGI for other property, etc. Okay. Charitable contribution deduction for corporations is also limited. It's a very different limit. 10% of taxable income. Now that's taxable income before the charitable contribution deduction. So we have to figure out what our charitable contribution deduction is and apply the 10% limit. So they say, okay, don't have to count the charitable contribution deduction when you're trying to figure out your charitable contribution deduction. That seems fair. We could do algebra to figure that out, by the way, but the lawyers who wrote the tax code can't do algebra, so we don't have to worry about it. Okay, so you don't have to count your charitable contribution deduction. Some other things you also do not have to count. Dividends received deduction, which we will talk about in Chapter 3, but we haven't gotten to it yet. Net operating loss carryback. We will talk about net operating losses, and we'll talk about how nowadays they only go forward. But every once in a while, Congress changes the rules so that, well, we're going to give you a net operating loss carryback. Well, you don't have to worry about it. So if they do change the rules, last time they changed it was because of COVID. They wanted to give people some money. So they said, we're going to let you carry your losses back for a little while. You don't have to go back and refigure your charitable contribution deduction if you are in a year that is then later on allowed net operating loss carryback. You don't have to reduce your charitable contribution deduction because of that carryback. Otherwise, it really doesn't count for much. The net operating loss carryback, as I say, is not allowed under current law, but it might be back. They've done it before. They may do it again. Also, the capital loss carryback. That is allowed under current law. And again, if you carry back a capital loss and are able to deduct it, you don't have to then go back and refigure your charitable contribution deduction for that year. Okay, so don't have to worry about the charitable contribution deduction itself or these other deductions. Dividends received deduction we'll see in a little bit. And the other two carrybacks, that just means you don't have to go refigure your charitable contribution if you change your taxable income due to a carryback from a future year. Deductions in excess of the annual limit are carried over, but the carryovers expire after 5 years, kind of like the capital loss carry forward would expire after 5 years if you don't use it. So same thing with charitable contributions. If you cannot deduct them because of your 10% limit, anything you couldn't take expires after 5 years. Charitable contributions, the deductible amounts for contributions of property, ordinary income property, general rule is the same as it is for individuals, deduct basis. But, special case, you might be able to get basis plus half of the appreciation. Inventory donated for the ill, the needy, or for infants. You can take the difference between fair market value and basis, which hopefully would be a positive number. If you're selling your goods at a profit, you would have a positive number there. And you can take half of your markup and also deduct that if you donate the inventory for the ill, the needy, or infant. If it is scientific property donated to colleges or research centers, And so this could be depreciable property where you have to treat the gain as, or you would have had to treat the gain as ordinary income. You can deduct basis plus half of the appreciation and back up the fair market value, because your basis could be zero if this is fully depreciated. But you can go back up halfway up the fair market value if it is scientific property donated to colleges and research centers, and also computer property donated to any school. So that could be K through 12 as well as a college, or also a library. Then again, even if you fully depreciated it, so your basis is zero, half the fair market value then could still be deducted as a charitable contribution. So general rule is all you can do is deduct basis, but you do have these special rules in these cases where you can bring it up to basis plus 50% of appreciation. Capital gain property, we know that the general rule is deduct fair market value, but sometimes the rule will be deduct basis, and that applies if it's tangible personal property. So don't worry about realty, don't worry about intangible property like stocks and bonds, but tangible personal property put to a use unrelated to what the charity does, that will be, the rule will be deduct basis, not the fair market value. Let's take a look at problem number 44. Aquamarine Corporation, a calendar year C corporation, makes the following donations to qualified charitable organizations during the current year. A painting, tangible personality, held 4 years as an investment, capital gain property, donated to a church which sold it immediately. Basis is $15,000, fair market value $25,000. That painting, we can only deduct basis, tangible personality that is donated and put to an unrelated use. If you donated it to an art gallery, they would put that painting to a related use. And so you could deduct fair market value. But you donated it to a church that just used it as essentially cash, turned it into cash immediately. They can, now they got $25,000 of cash for that painting. You can only deduct 15. Apple stock, held 2 years as an investment. That's intangible capital gain property. And they donated it to United Way, which again, sold it immediately. But it's intangible, so therefore you can deduct fair market value, $90,000 of fair market value. And canned groceries, held 1 month as inventory, donated to Catholic Meals for the Poor. So there's inventory donated for the needy. So you get basis plus half the depreciation. And that's going to be $10,000 of basis plus halfway up from $10,000 up to $17,000. So the $7,000 of appreciation, you can have half of it at $3,500. Total is $13,500. So our total deduction for charitable contributions, if we can take it all, we don't know what 10% of taxable income is, but we have available as a deduction $118,500, and they didn't give us anything about the Aquamarine's taxable income, so we don't know if we can take it or not. But that would be the amount that's available to deduct, and then we'll see if we can actually deduct it. Let's take a look at problem number 47, another charitable contribution problem. Julietta Sims is the president and sole shareholder of Sims Corporation, a cash method calendar year C Corp. They give us an address here. They're going to tell us to write a letter to Julia. That's why they gave us the address and the zip code. We'll just figure out what Julia's, what the answer to Julia's question is. We'll figure out the answer to Julia's question, but we're not going to actually write the letter. Julietta plans for the corporation to make a charitable contribution to the University of Washington, a qualified public charity, as are all universities. If you're tempted to have your corporation donate to your alma mater, go right ahead. She will have the corporation donate Jaybird Corporation stock, which has been held for 5 years, basis of $11,000, fair market value of $25,000. Julietta projects a $310,000 net profit for Sims Corporation in 2024 and a $100,000 net profit in 2025. Julietta calls you on December 10th, 2024, says, should I do this donation in 24 or 25? Maybe a combination of both. What should I do? And it says, write a letter advising Julietta about the timing of the contribution. Well, let's just do the number crunching. We'll let somebody else compose the letter. So 2024, profit before contribution is $310,000. The deduction limit is 10%, which is $31,000. So our deduction is the full $25,000. Intangible capital gain property, we can deduct fair market value, which is $25,000. 2025, she says the profit's probably only going to be $100,000 next year. So therefore, our deduction limit is only $10,000, and therefore our deduction is only $10,000 if we deduct it in 2025. We could carry it forward to 26, 27, 28, 29, and 30, cannot carry a contribution back to 2024. So therefore, it'll be $10,000 now and a carryover of $15,000 to 2026 and later years. So we're supposed to tell Julietta what we think she should do. And the answer is, it's a 21% tax rate either way, and you can get the full 21% deduction in 2024. There is no benefit to putting it off till next year. You still get a $25,000 deduction, but you'll have to wait to get the benefit. And so in terms of present value, the present value of a $25,000 deduction on the tax return you're going to be preparing, or your accountant, is going to be preparing for you in a couple of months, that $25,000 deduction is worth more than $25,000, which you might not even get to use all of it in 2025, 26, 27, etc. So therefore, donate it now. It's December 10th. As a matter of fact, I'm not going to write a letter. I'm going to call her up because you don't want to wait for something to get stuck in the slow Christmas mail, and she doesn't see it until January 2nd because it got lost in the mail. Make sure she knows about it before the year is up. Donate this stuff in 2024. Okay, that is it for the first part of our discussion of the corporate income tax. We will continue with more differences between individual and corporate income taxes in our second video.